Gautam Sinha joins us, fund manager with Motilal Oswal OMC. Gautam, good morning. Thank you for joining us. What is your take on the market? I am sure that you are also noticing what's happening on the macro front. Yields are at 7%. Crude is at $61. Are you getting worried about what's happening on the macro front?
I think globally inflation is coming back. There's talk of the Fed reducing the balance sheet, interest rates going up. So structurally, you're right. The global macro, which was so very favorable for us for a very long time, that seems to be changing at the margin. But the key question is, how much does it change? Because I don't think that this is going to be a V-shaped change in the macro, either in inflation or crude prices. So, well, a gradual improvement is actually good. Gradual inflation in commodity prices globally is actually good for the overall economy. So that's not something that I'm worried about. But yeah, the easy money that was made by PED dating because of interest rates coming down globally, that clearly is over. And I keep telling investors that going forward over the next 3 years, be prepared for some sort of PED dating in markets. When that happens, at what pace that happens is very difficult to gauge, but that's something that's a very high probability event for me now.
Gautam, you're finding value on dips, which is of course something that as a fund manager you would do in an orderly manner at all times. But where are you finding value in this market? A case in point being, now we're seeing Eicher Motors step back a bit after its earnings, and there being a scale up in Hero Motor and Bajaj Auto. Do you think that aside of sectoral rotation, within sectors, intra-sectors as well, there's going to be a shift in the low value, high growth companies?
Yeah, so the challenge today is really to find sheer value in the very obvious value in the markets in specific stocks, because valuations are rich across the board, and we are growth investors, and for us we are seeing that next 2 years, 3 years growth is largely getting priced in many stocks that we like to own. Of course, the situation has improved marginally over the last 1 month because of the sector rotation trade that has happened very strongly post recap bonds issuance news. But I think my way of playing this is basically to stick with the compounders, the long-term compounders, knowing fully well that there could be some sort of PED rating in the stocks over the next 3 years. But as long as the earnings growth is strong enough to more than make up for the PED rating, we should be fine. So I'm very focused on whether my stocks can deliver very strong earnings growth over the next 3 years, which I believe the stocks that I hold in my portfolio will. And if they don't, then obviously I'll take corrective action. And by and large, I am not this enthused by the results that we have seen so far. Pretty good set of results. I think from a longer term perspective, as long as my compounding in earnings is very strong, that should take care of any PED rating that might happen eventually.
One of the clear plays is OMCs. Given where crude is, what happens to OMCs?
Yeah, so we are very sanguine that the pricing power that OMCs have been given will remain with them. Of course, that might not get translated on a week-to-week basis. There could be sometimes a lag between how crude prices behave and how OMCs take price action. But if I see the marketing margins, they have been more or less steady since the price deregulation has happened. On the refining side, we have seen quite strong GRMs play out for these companies. So, and the more important bit with OMCs is talking about value. These are some of the stocks where there is some amount of value still left on the plate, because the PEs being so much lower than the broader market, so much lower compared to the kind of ROEs that they are making, even the kind of earnings that they are delivering. So it is more a valuation trade today than anything else, and we do believe that there are not much of concerns around their pricing power.
The big talking point this morning is,
and we have also seen the government take that excise cut. Yeah.
Oh yeah, absolutely. You know, the big talking point this morning, and we can't take our eyes away from BOB, the kind of, market mover it has become just in a short span after its numbers. And in that sense, there's a similar trend with BOB as well as SBI's numbers. The provisioning is coming lower, the asset quality is improving on a sequential basis. And all this seems to be turning around ever since the PSU Bank recapitalization got announced. How are you approaching PSBs now, and do they now form an integral part of your various portfolios?
So we keep looking at them. One important bit which has happened, of course, is the balance sheet. The hole in the balance sheet is largely to get filled with the recap that's going to happen. But from a sheer delivery of ROE perspective, growth perspective, if you look at GFCF to GDP numbers over the long term, I don't think that is going to move up meaningfully in the near future. And PFCs tend to, do very well on the growth front when gross fixed capital formation happens very strongly. And that is definitely not part of our core hypothesis today. So we don't see these as growth stocks, essentially. There would be a trading element definitely, especially because of the recap which has happened. Large part of it has played out. And there could be some more upsides coming from lower provisioning, although that might not play out as quickly as people are anticipating. But largely it's a trade, it's not a compounder, it's not a place where you'll make a lot of money surely from the fact that the company is going to be very profitable. That's not going to happen anytime soon.
Okay. So how does this, just replaying the theme that you highlighted earlier, I was looking at your top holdings, and you have a 7.5% stake in Maruti in the multi-cap 35 fund, which has done really well from a 3-year as well as a 1-year perspective. At what point would you look at scaling back a bit on Maruti and perhaps scaling up a bit more on M&M, which is what the market is focused on in terms of a value adjusted return play more because of what's going to happen with the rural economy and their tractor volumes? Does it not, as a fund manager, make sense to you to kind of take that sort of risk adjusted exposure?
So, when we're buying individual stocks, we are just largely buying them for the long-term potential to compound investor wealth. Because of their competitive dynamic, because of their positioning with respect to competition, because of their ability to earn superior market share, hence superior ROEs in the business. So, these are the factors that we consider. Somewhere, yes, some of the stocks that we own, the auto names that we own, are much more fully priced in today than they were, let's say, 1 year back. But even then, from a 3-year perspective, the auto story in India is only going to go one way, and that's up. And we believe that there is a lot of value from a 3-year perspective in the names that we hold. There, of course, are other companies which can do well, but definitely not something that we have liked so far.
Gautam, the portfolio which you run is a largely retail stroke or consumption facing portfolio, because if you own a Bajaj Finance or if you have exposure to insurance companies, these are largely retail dominated pockets. But the market style is changing because PSU banks are making a comeback, telecom has made a comeback. Are you also getting a sense that now the market style could really change some of these haloed expensive stocks which give you a lot of earning visibility? They'll continue to grow, but they may not generate very strong stock market returns.
Well, I find telcos to be the most expensive part of the market today, honestly, from earnings versus valuation perspective. And I'm not just talking current earnings, I'm talking 3-year out earnings too. So, that entire talk about value being there in telcos is completely wrong in my mind. PSU banks, there was a trade, but as I said, that's largely played out. Metals also a little bit of a recovery trade there. Metals, of course, doesn't fit in our style very well, so that's another constraint. So the answer to your broader question, while yes, we appreciate the fact that market style is shifting, it has shifted also in the past. These kind of phases keep coming and going. So it doesn't really change too much in terms of what we are doing, what we are looking for. So if we are looking for a certain kind of company, if from these set of sectors, let's say telcos and PSU banks, which by the way we keep evaluating every now and then, something fits into a style, we're very happy to buy it. In fact, that's the best thing that can happen for us. But as of now, that definitely is not the case. They are not going to fit into a strategy anytime soon.
Right. Gautam, just looking at the other themes in the market, and this morning the other talking point is also some of the pharmaceutical earnings. It's interesting what we've heard from the Sun Pharma management in their commentary, wherein they're extremely candid about some of the impending re-inspections. They've also highlighted that environment continues to be challenging and the pricing pressure in the US continues. And we've all debated and discussed for months altogether as to how pricing pressure and the demand environment for pharmaceuticals is in that grey area. But the key question now is, have the stocks already absorbed and taken cognizance of these negatives, or do you think there is still more downside on the table for some of these pharmaceutical names? Would they become now an investment case, or would you want to even relook at these names now?
No, actually, honestly, as of now, not yet. We are monitoring these names very closely and what's especially happening on the US generics front. Thankfully, in our portfolio, we continue to have very low exposure to US generics business. We have pharma names, but with very little exposure to US generics per se. See, the problem there is the amount of pricing as well as regulatory pressure which is coming down on Indian manufacturers or generic manufacturers, with Teva being close to filing bankruptcy and all that. So it is not something that I can predict the bottom of. It's like a falling knife situation. So we really have to see that bottom happening. We have to see the pricing pressure, pricing power coming back from some of these pharma names. And to my mind, that can only come through supply side consolidation as the marginal suppliers start to make so much losses that they shut down. So if and when that happens, I think pricing power can come back. But we don't see that happening in visibly in the near future. But yeah, that's something that we'll keep watching out for. If we see the trend changing, definitely that will be something that would interest us.
Right, Gautam, appreciate your time and glad you could join us. Bank of Baroda is up 2%, but the rest of the market is not looking all that charged up. I mean, the safe thing for us to look at indices and then make the market opinion. But for a change, if you look at the market breadth today, the gap